Hey, this is Justin from BreakIntoCRE.com, and in today's video, we're going to talk about the 3 different methods of valuations that appraisers use when appraising a commercial real estate asset. So if you're looking to buy a property and you need to get a property appraised by the bank and you want to understand how that property is actually going to be valued, stick around for this video. Now, if you're new here on this channel, we talk about real estate investing careers and real estate financial analysis. So if you're looking to break into the industry or advance your real estate investing career, make sure to subscribe and hit the notification bell. So when you're buying a property and looking to take out a loan on that property, the lender is usually going to have some sort of requirements as to some things that need to be done at the property before you actually close on the deal. And one of those things is likely going to be an independent third-party opinion of value through an appraisal. So when an appraiser goes and appraises your property, how do they actually come up with a valuation for your deal? Well, in this video, we're going to go over the 3 different methods of commercial real estate valuation for appraisal purposes. So let's start with number 1, and that's going to be the cost approach. Now for the cost approach on a new building, this generally just involves determining the construction costs of the building improvements and then adding the market value of the land. But for an existing property, this is where things usually get a little bit more complicated. The appraiser will still estimate the cost of the property improvements today, but they'll then reduce that cost by any physical deterioration, structural or functional obsolescence, or any external obsolescence from the surrounding area. So for physical deterioration, this may include costs to upgrade the improvement or cure any deferred maintenance on a property, and this will also factor in the useful economic life of the building and the time that has elapsed since the property was placed into service. Now for functional or structural obsolescence, this may include increased costs of operating an older building, such as energy costs for less efficiently designed buildings. This increase in cost will be taken as a present value analysis, assuming that that difference in cash flows would occur in perpetuity. The appraiser might also include external obsolescence, which accounts for influences outside of the immediate property site. So this can include factors like extreme traffic in the area, pollution, crime changes in the area, or anything that would materially affect the operating income at the property. So with all of these considerations to take into account for an existing property, it's no surprise that the cost approach is very difficult to use for anything other than a new structure. Now the next approach for valuation, if the cost approach isn't going to be sufficient, is the sales comparison approach. And this approach uses comparable sale data from properties that have recently sold that are similar in age, location, product type, and overall property quality. So adjustments could be made to the sale price for things like differences in sale date, geographic location within the submarket, building age, square footage, proximity to other landmarks, and other amenities or consumer draws that might exist at one property versus the other. So to determine an appropriate valuation for a subject property, the sale price of the comparable property may be adjusted upward to account for a superior location of the subject property. Maybe the subject property is slightly newer in build, and maybe the subject property is more highly amenitized than the property comparable as well. This approach works well when you've had a lot of transaction activity in your market within the last 12 months, specifically of the same product type and similar age and quality. But the more unique your subject property is and the less transaction volume that you have in your market, the less useful this method is. So if the cost approach and the sales comparison approach aren't sufficient to come up with a valuation, a third method that's used in real estate appraisal is the income approach valuation method. And within the income approach, there are 3 main subcomponents of how this is actually calculated. So the first is going to be the gross rent multiplier approach. And this involves dividing sale prices of comparable properties by the gross rent that those properties are going to generate on an annual basis. And what this is going to do is give you a number that you can actually apply to the gross rents of your specific property. Now, oftentimes this isn't all that helpful since most properties are going to have different expense ratios. So the second income approach method that's used is the direct capitalization approach. And in this method, instead of just taking the gross operating income, you're actually taking the net operating income of the property into account, which takes into account those operating expenses. So this method is really just applying a market appropriate cap rate to a net operating income value and taking that net operating income and dividing that by that market cap rate. And the way that appraisers will come up with a market cap rate is they'll take comparable sale data and figure out what the cap rate was on those sales and then apply that data directly to the subject property. So if several inferior properties sold for a 6% cap rate and the subject property that they're analyzing is in a better location and is slightly newer, they may apply something like a 5.9 or 5.8% cap rate to that subject property. And finally, the third income approach method, and the method that we use in many of our Break into CRE courses, is the discounted cash flow method. And this involves forecasting net cash flows over a significant period of time, usually somewhere around 10 years, coming up with what an assumption will be for the sale price of the asset, and then taking those net cash flows, taking into account revenue, expenses, and capital expenses, and taking into account those sale proceeds when you assume to sell the deal, and then applying a discount rate to discount those cash flows to come up with a valuation for the deal. Now, the discount rate is usually going to be the risk-free rate of return, or in the US Treasury rate, plus a certain risk premium that the real estate investor is taking on for investing in that real estate deal. And if you want to learn more about how to choose a discount rate in real estate, I made a video on that recently and I'll link that in the description below, so definitely check that out if you want to learn more about how a discount rate is chosen. So there you have it. Those are the three approaches to property valuation and the methods behind each. Now, commercial real estate investors rely on that discounted cash flow approach far more than any other approach we mentioned in this video. So if you want to learn more about how to run a discounted cash flow analysis and how commercial real estate investors run that analysis, I definitely recommend checking out my free real estate financial modeling crash course. And that's going to show you what a real estate financial model looks like from an ownership perspective. So how they're looking at cash flows and how they're coming up with their return metrics and what return metrics actually matter. So I hope that was helpful. If you like this video and want to see more content like this, make sure to let me know by hitting the like button, subscribe to the channel, and share this with anyone else who might find this helpful. Thanks so much for watching, and I'll see you in the next video.